Hello, this is Jason Benedict, and it's my pleasure to welcome you to this discussion of the financial statements. Now, there are three financial statements that we're going to talk about. The first is the income statement, the second is the balance sheet, and the third is the cash flow statement, which is also sometimes called the statement of cash flows. And so let's first talk about the income statement. Now, the income statement is sometimes called the profit and loss statement, which is sometimes abbreviated just to P&L. Profit and loss, or P&L, or the income statement. Now, what the income statement tells you is how profitable or unprofitable your business is over a given period of time. Okay? Over a given period of time. That's important, and we'll look at that a little more in just a moment. Now, the basic equation for the income statement is this: revenues minus expenses is equal to net income. Now, there are some synonyms for revenues. Revenues is sometimes called revenue, sometimes it's called sales, sometimes it's called sales revenue. And net income is synonymous with profit. So whenever you hear net income, you want to think profit. Thus, the income statement is sometimes called a profit and loss statement. Now, what I'd like to do now is take a look at a sample income statement from XYZ Manufacturing. Okay, so this is an income statement for XYZ Manufacturing Corporation, and it's for the period beginning January 1, 2011 and ending December 31st, 2011. And so it's going to include the financial transactions that take place during that time. And so what does XYZ Manufacturing do? Well, this company manufactures those steel doors, the roll-up shop doors. So they're a roll-up shop door manufacturer and distributor. They import the parts and they assemble them in their workshop, and then they install them in the shops. And so let's say that XYZ Manufacturing sells their doors for $500, and they sell 1,000 of them for that period of time, January 1, 2011 to December 31st, 2011. They sold 1,000 of these shop doors. So their sales revenue for that period of time is for those $500 per door times 1,000 sales gives them a total sales revenue of 500,000. Okay, so total sales revenue of 500,000. Now, remember our equation: sales revenue minus expenses equals net income. So now we want to consider the expenses for XYZ Manufacturing. The first expense that I want to consider is the cost of goods sold. Now, this includes, we're going to condense a number of expense line items. You can have an income statement that shows detail or summary. For the purpose of our illustration today, we're going to show a summary income statement. So what are the costs, the direct costs that went into getting those parts, assembling them in the workshop, and and getting them ready to sell. And so that's the cost of goods sold. Well, the cost of goods sold for XYZ Manufacturing, let's just say it was $200,000. We'll keep our numbers nice and round for the sake of the illustration. $200,000 was the cost of goods sold. Okay, now that gives us a gross margin, which gross margin is the sales minus the direct cost, or the cost of goods sold. It gives you a gross margin of $300,000. Okay, so $300,000. But that's the cost of goods sold, the direct cost that went into getting those doors ready to sell. Now, what about the other costs? What about the overhead of running this business? So let's consider some of those costs as well. Those are costs like the facilities cost. And we can imagine that the cost of keeping their facilities, utilities, rent, things like that, for this company totaled $70,000. Another major overhead expense is always salaries. Okay, salaries expense. So what was salaries expense? Well, we can imagine that XYZ Corporation has a couple of salespeople, a small installation team, a foreman, and the president. So the salaries for the entire company total $100,000. Okay, $100,000 in salaries. And then there's the other expenses. And again, since this is a summary, we'll just call that GSA, or General Sales and Administration Expense. And so we'll say that totaled $50,000. Now again, one thing you need to recognize is that these are nice round numbers. In a real scenario, they would never be this round, but we'll go with it for here, so for the ease of the math. So that brings us to net income, or the profit for this business. So can you do that calculation? We have our sales revenue minus our cost of goods sold. That gave us a difference of $300,000, but then we had the overhead expenses of $70,000, $100,000, and $50,000. When we do the math, that brings us a net income figure of $80,000. So that is, again, the income statement shows you how profitable or unprofitable your business is over a given period of time. Okay, we've taken a look at the income statement. Now let's take a look at the balance sheet.